Hello everyone, welcome back to Swadhyay. In the previous video, we have discussed part 1 of the chapter Residence and Scope of Total Income that deals with section 6 Residential Status of Persons. In today's video, let us discuss the Scope of Total Income part 2 of the chapter. Generally, residential status of a person is used to determine the scope of total income. It is the total income which is used to assess the tax liability of any person. So what all incomes of a person are included in this total income? That is dealt with in section 5. Section 5 deals with scope of total income of a person. What all incomes are included in the total income while assessing the tax liability of a person. Broadly, we have divided incomes into 3 areas. The first one is income received or deemed to be received in India during the previous year. The second one is income accruing or arising or deemed to accrue or arise in India. The third one is income accruing or arising outside India during the previous year. Based on these three areas and based on residential status of a person, we are going to determine what incomes are included in the total income of a person while assessing his tax liability. First, incomes which are received or deemed to be received in India during the previous year. These incomes are taxable for RORs, RNORs and non-residents. Irrespective of the residential status of any person, incomes received or deemed to be received in India during the previous year are taxable. Similarly, irrespective of the residential status of any person, incomes accruing or arising or deemed to accrue or arise in India are taxable. The first point, incomes received or deemed to be received in India, and the second point, incomes which are accruing or arising in India or deemed to accrue or arise in India are taxable in the hands of ROR, RNOR and non-resident. Irrespective of the residential status, these incomes are taxable. The third area deals with incomes which are accruing or arising outside India during the previous year. Such incomes are taxable in the hands of ROR, undoubtedly. Even if such income is not received or brought into India during the previous year, incomes which accrue or arise outside India are taxable in the hands of ROR. In case of RNOR, incomes accruing or arising outside India during the previous year are taxable only if such incomes are derived from a business or profession which is controlled or set up in India. I am repeating it once again. In case of RNOR, income accruing or arising outside India during the previous year is taxable only if such income is derived from a business or profession which is controlled or set up in India. If the business or profession is not controlled or set up in India, in such a case, such incomes are not taxable in the hands of RNOR. Coming to the non-resident individual, incomes accruing or arising outside India during the previous year are not taxable in the hands of non-residents. Here, it is given that for ROR, global income is taxable, irrespective of the fact where the person has earned the income. If ROR earns income in India or outside India, it doesn't matter. It will be taxable in his hands. In case of RNOR, incomes which are received or deemed to be received in India and incomes which are accruing or arising or deemed to accrue or arise in India are taxable. Similarly, in case of RNOR, incomes accruing or arising outside India during the previous year are taxable only if they are derived from business or profession which is controlled or set up in India. Otherwise, it is not taxable. Coming to non-resident, incomes received or deemed to be received in India during the previous year, incomes accruing or arising or deemed to accrue or arise in India are taxable in the hands of non-resident. Incomes accruing outside or arising outside India are not taxable in the hands of non-resident. Coming to the next topic, that is income received or deemed to be received in India. We have discussed the first area, that is income received or deemed to be received in India during the previous year. It is taxable for all ROR, RNOR, NR, irrespective of the place of accrual of such income and irrespective of residential status of the individual. Incomes which are received or deemed to be received in India are taxable. The Section 7 of Income Tax Act 1961 states incomes which are deemed to be received in India. Let us discuss what are those. The first one is contribution in excess of 12% of salary to recognized provident fund or interest credited in excess of 9.5% per annum. Here, a person has made contribution towards a recognized provident fund and such contributed amount is exceeding the 12% of his salary income. In such a case, such excess amount, the amount exceeding 12% of his salary, is deemed to be income received in India. The next case, contribution by central government or any other employer in previous year under a pension scheme under Section 80 CCD. The contribution is made by central government or any other employer towards any pension scheme for the employee under Section 80 CCD. That is, if the employer contributes for his employee towards the new pension scheme or pension scheme by central government or Atal Pension Yojana, such contribution is deemed to be income, it is considered to be income deemed to be received in India as per Section 7 of the Act. The third one, amount transferred from unrecognized provident fund to recognized provident fund, being employer's contribution and interest thereon. Here, the amount which has been contributed towards the unrecognized provident fund is now being transferred to recognized provident fund. Then, such contribution, such amount transferred, the amount so transferred is considered to be income deemed to be received in India. Going to our next topic, that is income accrued or arisen in India. First, let me explain the meaning of accrue. Accrue means the assessee has right to receive the income, not just assessee. If the right to receive any income becomes vested, becomes established with any person, it is said to accrue or arise. Also, let me clear one doubt. What is the difference between accrue and due? Accrue means, for example, if a person is working in a month of January, the salary for the work done throughout the month will accrue and becomes due on 31st or 1st February. When he is working day by day, the salary will get accrued on daily basis. And finally, on 31st January or on 1st February, such salary will become due. That means if right to receive is established, it is called accruing. The right to enforce the payment of same is called due. Here, it has been mentioned that incomes once taxed on accrual basis shall not be subjected to tax on its receipt. So once if the income which is accrued is taxed, on receipt of such income, it will be not subjected to tax again. The second point, incomes accruing or arising outside India cannot be deemed to be received in India merely because it is taken into account in balance sheet prepared in India. If there is an entity which prepares its balance sheet and shows incomes which are accruing or arising outside India in its balance sheet, still such incomes which are accruing or arising outside India will be taxable as per the residential status of such entity. Such income will not be considered to be income which is deemed to be received in India merely because it is shown in the balance sheet of the entity. we have discussed what are the incomes which are the meaning of incomes which are received in India or deemed to be received in India, as well as we have discussed what are incomes which are accrued or arisen in India. Now coming to our next topic, that is incomes deemed to accrue or arise in India. Incomes deemed to accrue or arise in India are discussed in section 9 of our Income Tax Act. There are total 8 points covered under this topic. Let us go through them one by one. Incomes deemed to accrue or arise in India. Any income accruing or arising to an assessee in any place outside India, whether directly or indirectly, through or from any business connection in India, any property in India, or from any asset or source of income in India, or through the transfer of a capital asset situated in India, would be deemed to accrue or arise in India. Here, the point states that the income is accruing or arising to the assessee in any place outside India, but directly or indirectly, through or from any business connection in India. First, let us discuss the point related to business connection. There are few exceptional points to this point, which states which deals with business connections in India. The exceptional cases are: in case of a non-resident, the following shall not be deemed to accrue or arise in India. The incomes in case of business in respect of which all the operations are not carried out in India. Here, the business operations, all of the business operations as a whole, are not carried out in India. In such a case, only few operations which are carried out in India and through which there is some income being generated, such income is taxable in the hands of non-resident. Otherwise, it shall not be deemed to accrue or arise in India. The second point is purchase of goods in India for export. A non-resident individual is purchasing goods in India and further he is exporting them to other countries outside India. In such a case, it is not the income arising out of such activity shall not be deemed to accrue or arise in India. The third point, collection of news and views in India for transmission outside India. A non-resident individual is engaged in a business of running any news agency, or he is publishing any newspaper or magazines or journals. And if he has collected the news and views from India and transmitted it outside India, any income being generated through such activity shall not be deemed to accrue or arise in India. The fourth point, shooting of cinematograph films in India. There are various movies like Life of Pi, Slumdog Millionaire and Extraction, which are for which shooting has taken place in India. If a non-resident individual is shooting cinematograph films in India and he is able to earn income through such activity, such income shall not be deemed to accrue or arise in India for non-resident individual. The fifth point is activities confined to display of rough diamonds in SNZ. There is a foreign company which is engaged in the business of mining of diamonds, and if such foreign company is displaying the rough diamonds in SNZs and it is earning any income from such activity, such income shall not be deemed to accrue or arise in India. In case of non-resident, these exceptions are applicable. What are those? The first one is in case of business in respect of which all the operations are not carried out in India. Purchase of goods in India for export. Collection of news and views in India for transmission outside India. Shooting of cinematograph films in India and activities confined to display of rough diamonds in SNC. If any income is being generated from these 5 activities for a non-resident individual, yet such income shall not be deemed to accrue or arise in India. Now, let us go further into our topic that here we have also discussed any income accruing or arising to an assessee in any place outside India, whether directly or indirectly, through or from any business connection in India. We have discussed this point in detail. The exceptions which are pertaining to this point in detail, we have discussed it just now. The next point is through or from any property in India, asset or source of income in India, and transfer of a capital asset situated in India. An assessee has a property in India from which he is getting a rent. Such rental income will be deemed to accrue or arise in India, even if such person has received the rental income outside India. If the property is in India, out of which he is able to earn rental income, such income is deemed to accrue or arise in India. Similarly, if a person is receiving an amount out of transfer of a capital asset which is situated in India, it may be the asset may be tangible, non-tangible, movable, immovable property. If a person is able to earn any income out of such activity, out of a transfer of capital asset, out of any asset or source of income in India, out of property in India, all such incomes are deemed to be incomes accruing or arising to an assessee in incomes deemed to accrue or arise in India. Coming to our next point, that is income from salaries earned in India. A person has rendered services in India and he has earned salary for that. It is deemed to accrue or arise in India. Similarly, income from salaries payable by the government for the services rendered outside India. Here, the government of India's central government is paying to the Indian citizen for the services he has rendered outside India. Still, such income is considered to be accrued or arised in India. Note this point. The person should be Indian citizen. He should receive salary from the central government. And the third point is he is rendering services outside India for the sake of government of India. In such a case, such income will be such salary income will be deemed to accrue or arise in India. The fourth point, dividend paid by Indian company outside India. It is deemed to be accrued or arisen in India. Fifth point, interest payable by government. Interest payable by government of India of any sort is considered to be income which is deemed to accrue or arise in India. Similarly, in second case, if the interest is payable by resident in India, it is deemed to accrue or arise in India outright. But such interest is payable by the person in respect of any debt incurred or money borrowed and use it for the purpose of business or profession carried on by him outside India. Or if such resident individual, he has taken debt for the purpose of making or earning income from any source outside India. Let us imagine I am a resident in India. I am running a business outside India. I am running a business in Sri Lanka or Nepal. And I have taken debt. On such borrowed amount, you are charging interest. Such interest amount will not be deemed to accrue or arise in India because I am running the business in Nepal, which is outside India. In such a case, such interest amount will not be considered to be deemed to accrue or arise in India. Coming to our next point, interest payable by non-resident when it is payable in respect of any debt incurred or money borrowed and use it for purposes of a business or profession carried on by him in India. Here, a non-resident person, let us consider a Nepali person. he is running a business or profession in India and he has taken debt from you on which you are charging interest. Such interest amount will be deemed to accrue or arise in India. Remember one point. The debt is taken for the purpose of business or profession carried in India. In such a case, such interest amount will be deemed to accrue or arise in India for you, and it will be taxable. If the business or profession is run outside India, in such a case, the interest amount is not considered to be income accrued or arisen in India. If the business or profession is in set up or control in India, if it is run in India, then it will be the interest payable will be income deemed to accrue or arise in India. If the business or profession is run outside India, in such a case, the interest amount will not be income deemed to accrue or arise in India. The next point deals with royalty payable. Royalty payable by Government of India is deemed to accrue or arise in India. Similarly, royalty payable by resident in India is also deemed to accrue or arise in India. But there is an exceptional case. Generally, we know that royalty is paid in respect of any right or use of property or information or services for the purpose of business or profession. So, if such royalty income is payable in respect of business or profession carried out outside India or for purposes of making or earning income from any source outside India, it is not deemed to accrue or arise in India. If the business or profession is set up outside India, then the royalty income which pertains to such business or profession or source outside India is not deemed to accrue or arise in India. Similarly, if royalty is payable by non-resident individual in respect of business or profession which is carried on by him in India or for purpose of making or earning income from sources in India, in such a case, such royalty income is considered to be income accrued or arised in India, deemed to accrue or arise in India. There is one point we have to remember in respect of royalty. Lump sum royalty paid by resident to a non-resident for transfer of all or any rights including license in respect of computer software along with computer hardware under any scheme approved by government is not deemed to accrue or arise in India. Here the keywords are lump sum royalty, which is paid by resident to non-resident under any scheme approved by the government in respect of transfer of all or any rights in respect of computer software along with the computer hardware. In such a case, such royalty income is not deemed to accrue or arise in India. Then the seventh point is any fee for technical services payable by Government of India and payable by resident in India. These are considered to be incomes deemed to accrue or arise in India. But there is an exception, that is, if the resident in India pays any fee for technical services for the business or profession carried on by him outside India or for purpose of making or earning income from any source outside India. The business or profession or source is outside India. In such a case, then the fee for technical services is not considered to be income deemed to accrue or arise in India. Similarly, if any fee for technical services is payable by non-resident individual, if it is payable for the purpose of business or profession carried on by him in India or for purpose of making or earning income, earning from source in India, it is deemed to accrue or arise in India. The point number 5, interest payable, point number 6, royalty payable, and any fee for technical services payable. These are summarized as below in this master illustration. Interest on money borrowed, royalty paid, fee for technical services paid by resident in India for business or profession or for earning income from any source in India. In such a case, it is taxable for ROR, RNOR and non-resident. If the business or profession is outside India, it is payable by resident in India and the business or profession is carried out outside India. In such a case, these incomes are taxable only in the hands of ROR, not RNOR or non-resident. Similarly, interest on money borrowed or royalty paid or fee for technical services paid by non-resident for business or profession or for earning income from any source in India is taxable in the hands of ROR, RNOR and non-resident. But if the business or profession is outside India, then it is taxable only in the hands of ROR. Simply put, if the business or profession or the source of earning income is in India, then it is taxable for all. If the business or profession is set up outside India, such incomes, the interest on money borrowed, royalty and fee for technical services are not taxable in the hands of RNOR and NR. It is taxable only in the hands of ROR. Coming back to next point, the 8th point, which says income arising outside India being a sum of money paid without consideration by a resident Indian to a non-corporate or a foreign company or non-resident or RNOR, where such income aggregates to more than rupees 50,000. Here the Indian resident is paying to a non-corporate or a foreign company or a non-resident or RNOR an amount which aggregates to more than rupees 50,000 outside India, and he is paying this amount without any consideration. He is not expecting something in return. In such a case, such income which aggregates to more than rupees 50,000 is deemed to accrue or arise in India. Now that we have revised all the 8 points which are covered under the head incomes which are deemed to accrue or arise in India under section 9, we have come to the end of the chapter, and let us discuss one master illustration which has been made by us after gathering all the points. We have covered all the incomes which have been covered in the which are given in the institute material, and we have made one master illustration. I hope we have covered all sorts of incomes under each and every head. Let us once discuss the master illustration and end the session. Determine which of the following incomes are taxable. Here we have taken incomes from each and every head: agricultural income, salary income, house property rent, and we have categorized persons into ROR, RNOR and non-resident. We have to determine which of the following incomes are taxable for which persons. First comes the head agricultural income. Agricultural income from land in Gujarat, rupees 25,000. Since agricultural income arising out of India, the Indian agricultural income is not taxable, it is exempt. For ROR, RNOR and non-resident, such agricultural income of rupees 25,000 is not taxable. Next, agricultural income from Nepal, rupees 2 lakh. Since the agricultural income is arising out of India, outside India, it is taxable in the hands of ROR only. In the hands of ROR, global incomes are taxable. So, since the income is arising outside India, it is taxable in the hands of ROR as per our Indian income tax provisions. Whereas for RNOR and NR, it is not taxable as per our law. Second head, salary income. salary computed rupees 5 lakh earned in India. Remember this point. Whenever in question it is mentioned that if salary or house property rent is mentioned with computed, the word computed in the brackets, remember the deductions which are applicable on such income. The standard deduction is already provided for. So here salary computed amount is rupees 5 lakh earned in India is taxable for all. Since it is received in India, it is taxable for ROR, RNOR and NR. The next head is house property. House property rent. In rent from house property in Bhopal computed rupees 1 lakh. It is taxable for all since it is arising in India. Rent from house property in Nepal rupees 2,50,000. Here the word computed is not mentioned beside the word rent. Hence what I have done is I have taken 30% standard deduction on rupees 2,50,000. So the net income, the net rental income is 2,50,000 minus 30% of 30% standard deduction, which equals to 1,75,000. This 1,75,000 is taxable in the hands of ROR only. Since it is outside India, it is not taxable for RNOR and NR as per our Indian income tax provisions. Then comes rent from house property in London remitted to India rupees 75,000. Similar to the previous case, the rent from the house property is in London and it is remitted to India. Here, if the amount is remitted from outside India to India, such incomes are not taxable in the hands of RNOR and NR. Remittances are never taxable in the hands of RNOR and non-residents. Hence, since the property is outside India, the income is arising outside India, it is taxable only in the hands of ROR. And that too, I have taken rupees 52,500 after providing for standard deduction of 30% on rental income. Next is business income. Under this head, the first point is income from business in Chennai rupees 20,000. Since the business is based in Chennai, it is taxable in the hands of all. It is received in Chennai. The income is deemed to accrue or arise from India. So it is taxable for ROR, RNOR and NR. The second point, income from business in Delhi controlled from London. Though the control is established in London, the business is physically set up in Delhi. So the income is deemed to accrue or arise in India. The income from such business is deemed to accrue or arise in India. Hence, it is taxable for ROR, RNOR and non-resident. The next point, income from business in Germany controlled from Delhi, of which rupees 70,000 income amount, rupees 40,000 is received in Delhi. The business is set up in Delhi, Germany, but it is controlled from Delhi. Here, in case of RNOR, we have discussed one point. Income accruing or arising outside India during previous year is taxable in the hands of RNOR, but only if such income is derived from business or profession controlled or set up in India. Here our question says, the income from business in Germany is controlled from Delhi. In such a case, the whole amount of rupees 70,000 will be taxable in the hands of RNOR. Similarly, in the hands of ROR, the whole amount of rupees 70,000 is taxable, and for RNOR too, the whole amount of rupees 70,000 will be taxable. But in case of non-resident, the portion which is received in India, the portion which is received in Delhi will be taxable, that is rupees 40,000 only. The next point, income from business in Russia controlled in Russia, rupees 20,000. The income is set up in Russia, the control is in Russia, hence it is not taxable in the hands of RNOR or non-resident. It is taxable only in the hands of ROR. Next point, profession in Kenya, which was set up in India, received in Kenya and spent in India. Since they have mentioned spent in India, we might get confused and think the whole amount of 5,000 will be taxable for all. But no, the profession is set up in Kenya. The profession is in Kenya, which was set up in India, received in Kenya and spent in India, rupees 5,000. It is taxable in the hands of ROR. And since it is set up in India, it is taxable in the hands of RNOR too. The first point under the head capital gain says capital gains on sale of shares of Indian company in India, rupees 60,000. Since the shares belong to Indian company, it is taxable in the hands of the sale consideration is taxable in the hands of ROR, RNOR and non-resident. The next point, capital gains on sale of shares of Indian company received in Germany, rupees 15,000. Though the amount is received in Germany, outside India, since the shares belong to Indian company, the income, such income is considered to be incomes deemed to accrue or arise in India and hence are taxable in the hands of ROR, RNOR and non-resident. The next point, capital gain on sale of plant in Germany, rupees 40,000. The income has arisen outside India. So, it has nothing to do with the taxability in the hands of RNOR or non-resident as per our Indian Income Tax Act. Only such income will be taxable in the hands of ROR. The next point, capital gains on sale of plant in Germany, rupees 40,000, of which 50% is received in India. The portion which is received in India will be taxable in the hands of RNOR or non-resident because the plant is set up in Germany, outside India. The income is arising outside India, but the portion which is received in India will be taxable in the hands of RNOR and non-resident. Hence, only 20,000 will be taxable in the hands of RNOR and non-resident. Whereas for ROR, the whole amount of rupees 40,000 will be taxable. Dividend income. Dividend income received from Indian company, rupees 5,000. Since the company is Indian company, it is taxable in the hands of all. Dividend income received from Japanese company, received in India, rupees 5,000. The dividend income from Japanese company received in India, rupees 5,000. Incomes received in India are taxable for all assessees. Then, dividend from British company received in London, rupees 10,000. The income has arisen outside India. So, it is taxable only in the hands of ROR. Rupees 10,000 is taxable only in the hands of ROR and not RNOR or non-resident. Dividend income from Indian company paid in London, rupees 20,000. Though the payment is made outside India, though the assessee has received dividend income outside India, it is arising from Indian company. Hence, it is taxable in the hands of all assessees, ROR, RNOR and non-resident. The next head is interest. FD interest from bank in India, rupees 1 lakh. It is arising in India and hence taxable for all. Savings bank interest from bank in India, rupees 12,000. Similar to the previous case, it is also taxable for all assessees. Then, interest on UK development bonds, 50% received in India of rupees 10,000. The interest amount belongs to UK development bonds. So, the income is generated outside India. But 50% is received in India. So, the portion which is received in India is taxable in the hands of RNOR and non-resident to the extent of rupees 5,000, that is 50% of 10,000, rupees 5,000 will be taxable in the hands of RNOR and non-resident. Whereas for ROR, since global income is taxable, the whole amount of rupees 10,000 will be taxable. Interest on debentures in Indian company received in London rupees 12,000. The debentures belong to Indian company, but the income is received in London. Since the debentures are of Indian company, the interest income is deemed to accrue or arise in India. Hence, rupees 12,000 will be taxable for all assessees. Interest on money borrowed or royalty paid or fee for technical services paid. This point we have discussed just before we have started discussing the illustration. Once again I will repeat. Interest on money borrowed or royalty paid or fee for technical services paid by resident in India for business or profession or for earning income from any source. If the business or profession is set up in India, it is taxable for all. If the business or profession is set up outside India, it is taxable only in the hands of ROR. Similarly, if non-resident is paying you the interest on money borrowed, here the non-resident is paying the interest on money borrowed or royalty or fee for technical services in respect of business or profession or for earning income from any source. If it is in India, it is taxable for all. If the business or profession is outside India, it is taxable only for ROR. With this, I have tried to cover the illustrations which are given in our institute material. I hope this video is helpful for all of you, and I will be uploading further videos on the topics house property salaries in upcoming days. Thank you all for watching, and let us meet again while discussing further topics of our subject. Thank you.